Good evening. This is Duane Lowry for the DPP Grain Desk on Sunday, May 6th. I think there's probably quite a few things to talk about tonight, and I think in order to talk about them in the proper context, we probably got to go back to Friday's performance and deal with that a little bit. But let's first touch on some of the immediate things that will be impacting tonight's trade. Weather is bearish. I don't know how else it could possibly be viewed. Weekend rains in the Midwest hit some of the drier areas of the northwestern part of the Midwest. The next 2 weeks offers some improved and planting opportunities. We should see planting progress proceed well over the next 10 days once the fields dry out from recent rains. A lot of planting will be complete by the 15th of May, corn and beans both. So I don't see how we can look at weather and see anything here that's other than being bearish. It is probably fair also to say that favorable weather has been a talking point and certainly a known item, so maybe it's a little bit of an old news item, but weather is not bullish at all. Friday's price action, we did see some panic-styled selling activity early in Friday's trade. The market was able to shake that off and recover nicely. Pretty much in all markets recovered well, even though corn closed lower. In new crop corn, it still closed well off its lows. So you got people that will look at Friday's price actions from a couple different perspectives. First of all, you got to realize that most traders have had a bullish bias on corn for months, and that has not changed. And so they'll look at the corn price action as being a supportive, and they'll be hoping that this is the bottom side of price parameters, and they'll be hoping that this is as cheap as we get until we can be confident we don't have a weather scare ahead of us during the growing season. I don't particularly share that view, but I think that will be a relatively common view, or a common hope at least. Wheat market traded the lowest it's traded at any time for the July 2012 wheat futures on Friday, and I think that's an important thing to remember. The wheat market has been a drag on corn values, a threat to corn downside risk, and a limit to corn upside potential. Northern Hemisphere wheat crops look to be good. U.S. carryout is going to remain large. Global carryout is going to remain large. There's no reason to believe that prices can't stay under pressure going into the Northern Hemisphere wheat harvest. And I think that's a drag on corn values. Short-term technical conditions on wheat, probably a little bit oversold. And this coming Thursday, we have a USDA report. More than likely, it's going to show more bearish data in wheat, but that's certainly known, certainly expected. There's no surprise there. So I wouldn't be surprised we get some sideways activity in wheat, some trading range activity going into Thursday's USDA reports. That probably means that last week's lows, which were made on Friday, that's the bottom side of pre-report price levels probably. Upside potential is going to be very limited above Friday's highs, but it's not impossible to see values checking out Friday's highs sometime here this week again. But such strength, although minor, probably still needs to be seen as longer-term selling opportunities. Wheat values still have, I'd say conservatively, 50 to 75 cents of downside potential between now and harvest lows. I think it's also possible to consider the idea that with the wheat futures offering a lot of carry, whatever those nearby lows are made at harvest time, some of the deferred contracts may also have to go to those price levels, which means D-Sweet might have maybe $1 of downside risk from current levels. So that the fundamental outlook in wheat is not good. We probably have not yet hit the bottom side of price parameters for harvest lows, so to speak. And it may be a situation that once we find that level, wherever it is, we may spend some time down there. And that is a burden to the corn market, both in terms of upside potential and in terms of downside risk. As far as corn is concerned tonight, beneficial rains fell over the weekend in some of the drier areas of the Midwest. That'll weigh on values. But here too, Friday's price performance certainly had some panic-style selling noted early, and the corn did manage to trade below recent lows in Friday's performance. In fact, it's the lowest prices seen by December 2012 futures contract since going back to mid-March of 2011, more than a year ago. The Dees corn market over the last several months has had about 590 on the top side. It's been a lot of trading range activity, a lot of back and forth activity, but definitely with a downward slant to it. And Friday's probe to 515, that was the lowest prices we've seen for a long time. And I think that if you look at December corn, 550 is probably the downside breakout area. It's going to be very difficult for the corn market to get above 550. And I think it's not unreasonable to even look at it from the perspective that 530, 540 is going to have a difficult time getting a test of that. And we closed Friday at 524 and a quarter. So the reason I offer that out there as a perspective is while this is the lowest prices we've seen in 14 months, give or take, while it's the worst prices you've seen in several months for new crop values, and new crop values are well below what producers have become accustomed to, I think it isn't important that this is the lowest values we've seen in 13, 14 months, and it isn't important that these are the bottom side of parameters in the last several months. What is important is we have the fundamental backdrop here with large acres, off to a good start, trendline yield potential, the weight of a U.S. and global wheat market that suggests or warns that while current levels are at the bottom side for a long time in terms of price parameters, it is possible and certainly conceivable and not at all unreasonable to consider the fact that current price levels at this 525, 530 area December futures, it's very possible that from here forward into harvest, so basically from here forward for the next 6 months, give or take, it's possible these could be at the upper end of price parameters in that particular window. And I think that's the problem that the producer must face and must deal with and attempt to protect downside risk. With 525 futures, what is your downside potential? Between now and the acreage report at the end of June, 6-7 weeks away, to say that December futures couldn't go to 450 to 475, I think would be a mistake. I think that much downside risk exists in that particular window. If you extrapolate the growing season and we end up having a favorable, acceptable growing season into harvest, and we end up with trendline yield, something like that, $4 December corn futures is not an unreasonable possibility. Since 2008, you could go back and find some of the years that we had some very high prices in summer and still find significantly cheaper prices at that by the time you get to harvest. And I think that's a downside risk that you have to be concerned about. So even though prices are at the bottom side of recent parameters, an honest evaluation of what we are currently looking at in terms of fundamental factors still warns that this may still offer a lot of downside risk. And I think producers right now still need to be worried about trying to protect those downside risks. Maybe it's an option strategy, maybe it's cash forward contract, maybe it's a short futures hedge position. Who knows what it's going to be? Every operator is going to be a little bit different, but you've got to seriously evaluate what these downside risks are, look at your costs, and determine whether you can still justify seeking some downside price protection at current levels. As far as soybeans are concerned, Thursday we get a monthly supply and demand report from USDA. Traders expect that USDA will offer the first look at new crop balance sheets on Thursday. They expect the soybean balance sheet to look bullish, have a small carryout figure. They're going to be using their planting intention acres, we assume, and they'll be using something around trendline yields. But we need to keep in mind that the final soybean acreage is going to be higher than that March estimate. It's going to be driven higher based on declining corn price trends and outlook and trader sentiment towards corn. It'll be driven by higher new crop soybean prices, more aggressive bullish sentiment, and I think producers will respond to that. You're also going to have every incentive possible in the world to create double crop acres on as many acres as possible, and it appears as though we're going to have wheat harvest moving in a pathway pace that will allow maximum double crop acres to go to soybeans as well. So I think there's a lot of factors there that cause the new crop ultimate beaten carry out and balance sheet to look much different than what we're going to get Thursday. However, traders are fearful of an expected bullish report on Thursday, and I think that's going to limit how much their willingness there will be to embrace early weakness that may be driven on weather or whatever it may be. So I think we look at weakness to start, but I'm not sure that we can build momentum in front of Thursday's reports, even in corn and wheat below Friday's lows at this time. I think we look at some choppy trade in front of that report, but short-term rallies in wheat and corn above Friday's highs need to be searched for selling opportunities. I think the selling resistance in beans will be there, but I think it may stay up closer to recent highs and not be real close to where you finished here Friday going away. Outside markets might also be interesting. The French elections and Greek elections may cause some mixed reviews in the financial markets. The Greek elections will be seen as nervous and creating uncertainty in financial markets. That might be a little bit negative. The French elections will be seen as maybe seeing Europe move away from austerity measures and making stimulus spending a more desirable path. That might be seen as supportive some commodities, maybe weaker against the dollar. So there are a lot of things to watch play out there. So outside markets may have some influence. I wouldn't be surprised those outside markets provide some recovery from Friday's weakness as the week unfolds and possibly help create a little bit of support to the grain trade as well as the week unfolds. So look for lower values to start, but I'm suspicious that we see both sides of activity for the week as the week unfolds. But keep in mind that wheat and corn continues to have probably limited upside potential above Friday's highs and probably much greater downside risk over the next several months than any of us really want to admit to. For the DPP Grain Desk, this has been Duane Lowry. Thank you.